In this session, we're going to look at current valuations on both the US and Australian equity markets and consider the usefulness of a range of different valuation methods in looking at subsequent returns from various asset markets. So as you can see just in the screen in front of us, we have the a Shiller or a Cape PE for the US. The blue line represents reported real earnings based on 10-year moving average of those earnings, and you can see the market's still expensive despite the sell-off. And then the red line shows the same measure, but this time using operating earnings. Again, having come off the recent highs, but still on the slightly expensive side. If we also look at the Australian market, for similar sort of measures, although this time, there's two that we're using. The blue line on this one is a bit different, but the Shiller PE is the red line. That has the market around about average, so Australia doesn't appear to be expensive. However, a problem with this is that using the last 10 years average earnings tends to reduce the PE because earnings have been somewhat elevated. If we take a longer term trend using a regression through earnings back to 1950, we find the market slightly more expensive, as shown in the blue line there. Of course, other valuation methods are used. More commonly, people will be referring to the forward PE. For example, in the Australian market, that too has come off, sitting down at around about, if we look at the actual data, sitting at about just under 14 times, or just over 14 times. And then likewise, which is by coincidence roughly around the average at this stage. And then if we look at the same measure for the US, USPE is back in line with its longer term average. So all these measures, certainly the forward PE measure, seem to be around about average. The longer term Cape type measures, if anything, still on the relatively expensive side. So what does it mean for subsequent returns? So if we investigate the US first, and I'm going to look at subsequent 12-month returns, and we will use, to begin with, we will use the forward PE, this particular one. So the dot, or the XY chart here is plotting down the bottom the forward PE, and the Y scale has the total return from US equities in the following 12 months. So you can see there that it's not a very strong relationship. There's an R squared mentioned below of 0.15, so not a very strong relationship over the near term. What about for some of the other valuation measures? Well, we were just talking about Shiller, so let's use that particular measure. And once again, you can see here it's got a very low R squared, so it doesn't seem to have offer much in the way of insight into subsequent returns in the next 12 months. Another measure is just to look at the trailing trend, which again is sort of a long-term measure, 0.13, quite a low R squared. We could look at earnings yield, bond yield in the US, again, very low R squared. So it seems fairly clear that in just looking at the US and a range of different valuation methods that they're not that useful over the very short term, which is perhaps no surprise. Let's choose one more, dividend yield. There, as you can see, they're also not a very good relationship between the two. So if we extend that out a little bit and we say, okay, let's look at, say, 2-year returns. So I'll do that for the US. Total returns over the next 2 years. And this time we're going to look at it, let's pick up on the EY-BY, so a very loose relationship still using that measure. If we use the forward PE, R squared jumps up to about 0.24, but still not very strong. If we use trailing operating earnings, again, not that strong, 0.21. And I will use dividend yield, likewise. And if we start using a Shiller or a Cape PE, you can see there now that the R squared has increased, but it's still quite a low 0.17. And then using a trailing trend PE, so not a 10-year but a long-term regression, you still get quite a low outcome. So very similar results once again. So let's now look at longer term. I'll skip 5 years, we'll go straight over to 10 years. So we're looking at the subsequent 10-year annualized returns from US equities. I'm going to relate that to EY/BY again. Again, very loose relationship there. For the forward PE now, we don't have a lot of data here. Our forward PE measure starts in the late 1980s, but you can see the relationship does tightened up quite considerably over the subsequent annualized 10-year return periods. So there seems to be a reasonable amount of information content in current valuations for the following 10-year returns. Using a Shiller PE, likewise, that R squared now has jumped to 0.7. And then the trailing trend very similar, around about 0.74. So fairly clearly shows you that valuation measures, most of them improve with time. Some don't improve much at all, like earnings yield, bond yield wasn't a very strong valuation measure in terms of judging subsequent returns. Likewise, the equity risk premium, which we didn't go into, is proven to be not a very accurate indicator of subsequent returns. I'll turn now to Australian equities. We'll jump straight into the 10-year returns. So ASX 200, and here I'm looking at earnings yield, bond yield. So similar to that of the US, not very strong. Dividend yield, there is some information there. So this is 10-year annualized returns in the subsequent 10 years compared to the current dividend yield. So it does provide, I suppose, some insight. The forward PE for Australia, not as nearly as strong as the US in the US case. Trailing PE, we get an R squared of about 0.5, so it does have reasonable information content there. And as we saw in the chart earlier on, we can use trend EPS PE or a CAPE or a Shiller PE. This is the trend number. So trend earnings produces an R squared of about 0.55, and then finally a Shiller PE, and you can see there that it jumps up to quite a high level of 0.7. So a strong relationship between Shiller or trailing trend PEs and subsequent returns over the next 10 years. I'll just jump back to the 2-year return. And now we're looking at ASX returns over the following 2 years, and we're going to compare that to EY/BY. Once again, not a very close relationship. Forward earnings, forward PE, I should say, not very close at all. Trailing PE a bit better, but still quite low at 0.1. Trend EPS and PE, not bad. 0.26, but not that strong, and typically only at the extremes do we get a strong relationship. And then finally, a CAPE or Shiller PE, reasonable but not very strong, so not to be relied on. So a lot of focus does get placed in terms of valuations and what it means for markets. Just looking at this sort of simple analysis would suggest that valuations and their relevance to returns from markets tends to have the greatest applicability over horizons beyond, or 3 years and beyond, preferably out to 10 years. Thank you.